Have you ever wanted to buy a small business but didn't think you had the money to do it? Well, you might be closer than you think. And I'm gonna go over the top 2 strategies real entrepreneurs are using every day right now to buy small businesses. Now, as a business and tax lawyer, I've been helping clients for decades buy and sell businesses. I've seen the real deals, what works, and how deals actually get negotiated and closed and financed. Now, the top 2 ways people are buying businesses with little to no money down are creative finance and SBA loans. Now, I'm gonna go over both of those strategies here, how to negotiate them, what the terms should be, and what to expect. But those are really the top 2 ways people are buying small businesses. People are not coming out and buying businesses with $500,000 cash for a business that's for sale for $500,000. That just does not happen. So don't think you need to come in with cash to buy a small business. Most people selling a small business understand this. There's gonna be some seller notes and carrybacks, and there's gonna be some seller financing involved. I'm gonna go over how that works when you're doing creative finance. Or you can use an SBA loan, which I'm gonna be talking about, which is a government program that banks get a guarantee on it, so they're much more liberal in lending the money, kind of like an FHA loan when you're buying real estate. So I'm gonna go over how you qualify for that, and there is some small down payments you have to come up with, but there's some creative strategies to get there as well. All right, so let's start with just creative finance in general. I've worked on so many business transactions where not $1 passes at closing. Instead, what happens is the new buyer of the business negotiates the purchase price. We'll talk about how to negotiate that and value the purchase, but in principle here, just think, you negotiate a purchase price, you negotiate a deal. Now there might be a price for the business, let's say it's $500,000 for this small business. That's gonna be paid out over time. The seller of the business is essentially gonna finance it for you. So if they're owed $500,000, you might say, I'm gonna pay you over 10 years to purchase this. Seller of the business, you get to walk off into the sunset. You don't have to worry about the hassles of the small business. You might be burnt out on it. You might be moving on to something else. I'm gonna take this business over for you, and I'm gonna pay you over time. And there's gonna be an interest rate usually attached to that. So as a seller of a business, they're like, great, I like this. I'm getting a stream of income. I don't have to be in the weeds of my business anymore. I can go on to whatever I'm doing, retirement, my next thing, whatever it may be. And the buyer is gonna come in with the responsibility to operate and pay me over time. And if they don't, I can come and take the business back. So if they default, just like the bank that loans you money when you buy a house, what the seller of the business can do is say, hey, if you don't pay me back, I'm gonna foreclose back on you to get my business back. And so that's terms negotiated typically in what's called a seller finance note. Now, sometimes there's some cash in note. You might have 5% down or 10% down or more in cash coming in at closing, and the balance is seller finance. Now, obviously it depends on what you can negotiate. It depends on the circumstances. Some sellers of businesses are in a distressed situation. They're happy to sell or finance with 0 money down. They just need to get out of the business for whatever reason. There's a family issue, there's a divorce, there's a death. I mean, there are so many businesses right now that need to be transferred down to the next generation, and the next generation doesn't want it. The kids don't want it. And mom and dad might have built this business, or there might be some business owner that's built this over time. They have no one else to pass it on to. There's no employee that wants to take it over. There's no person that's right for that. And so they're looking for people to come on to take this responsibility, take over the business, and get the value back out. Another strategy that's used when we call creative finance, so to speak, is if you're an entrepreneur wanting to acquire small businesses, use some seller finance. That's so common. It is like 9 out of 10 small business sales have some form of seller financing, whether it's a small piece or a large piece. It is so common to have seller financing. So don't think that's off the table. That is usually on the table. As a buyer, you should be using that and utilizing the seller and the value that they've created in the business to get paid out over time under a loan, the seller finance note over time. Now, another way you can come up with it, let's say you're in a deal where it's like, hey, the seller wants some cash. They want 20% down. They want 30% down. They want to cash out a big piece of this right now. They'll take a note for the balance over time, but they really want to make sure that I'm serious, or for whatever reason, they need a cash injection. Another reason a lot of people have to sell businesses, they got tax debts. They got other issues or creditors chasing them down. They got to monetize some value out of the business, and that's a great opportunity to come in and buy too, because they're in somewhat of a distressed situation. Sometimes you can get a great deal, but they need some cash. A great strategy we see very commonly used is bring in an outside investor. Find a cash investor that's willing to come in with you. This could be their personal funds or maybe their self-directed IRA, right? And that cash can come in and they either partner with you in the purchase where they get a piece of the business. They're not gonna be working in the business. You're gonna be the one taking over the business, responsible for it. They're kind of a silent cash partner coming in throwing in cash, maybe getting a piece of equity in it, or they could be a lender at a higher rate. They could be lending you the money to acquire this business at maybe a 10% or 12% or higher rate of interest, because it's a little bit riskier of a loan than maybe what the seller's gonna be taking on their portion. So think of using other investors that can come in, private money lenders, other people you know that may wanna be involved in small business but don't wanna operate it. They kinda wanna be on the passive side of that. There's a lot of money out there looking for opportunity. So if you're an entrepreneur or someone sourcing deals and you find opportunity, there's a lot of people out there with money on the other side of this that are like, I just don't have the time or resources to go find deals, but I'd like to put some of my money into small business rather than more money in the stock market. And this could be people's IRAs or 401ks. There's $35 trillion there that can be invested in small businesses. People's IRAs and 401ks don't just have to buy stocks, bonds, and mutual funds. So consider bringing in an investor that gets you that cash to be able to close the deal. Now there's so much variations here in creative finance, but it depends on the deal, it depends on the seller's needs in getting out. And this is where, as an entrepreneur coming in and negotiating, you gotta find those pain points. And maybe you do need to get some cash in on the deal. Maybe that's not necessary, and you can get the deal done with zero to little money down. All right, now let's talk about SBA loans. This is a growing area that's financing small businesses. It's always been around, but the SBA has actually improved the rules to make SBA loans more available to people acquiring small business, like existing small businesses. Now, there's been changes in the rules in 2022. What you need to know right now is these are gonna require 10% down. Now there's some discrepancies in some banks on whether they'll allow that to be seller financed or not. As a rule of thumb, most banks that are very active in lending to people buying small businesses are going to require 10% down from the buyer. And typically you'll see another 10% seller financed. They like that. And then the other 80%, the bank is going to fund the loan. So let's say a small business that you're purchasing for $1 million. You might have to put 100,000 down. The seller is going to carry a note for 100,000 and the bank's going to throw in 800 grand. At closing for that $1 million business, the seller's getting cashed out $900,000, right? They got your 10% down as the buyer. They got the bank's 80% in that example, and the seller's got $100,000 they're gonna be owed over time. And that note might be a 2-year note or something that gets paid out over time as you're getting into the business and taking it over. But these SBA loans are much more likely to get approved. Now it's gonna depend on, can you come up with that down payment? Which again, maybe you get a private investor that helps with that if you don't have it. It'll also include your credit. You've gotta have decent credit, all right? So if you've got judgments or bankruptcies in the recent past, this is gonna disqualify you for an SBA loan, but you don't have to have like 800 credit score, okay? Let's make sure you're 650 or above and you don't have like a bankruptcy or judgment. That's gonna be good enough credit for an SBA loan. Then of course, they're gonna look at your background. So do you have the necessary skills to run this business? If you're buying an auto body shop, have you worked in an auto body shop before? What do you know about auto body shops? Are you just a car nut that gets the magazines and follows Instagram accounts? Or do you freaking know how to repair a car or how to write service orders? How do your background and experience fit into this? But this is not always just like one, you have to have exact experience in that exact industry. That's not required. For example, I had a client selling a flooring business, and the buyer of that business just came out of corporate America and from a financial services side of the business. But they had managed people. They'd had a 20-year career in management and leadership positions in a financial services industry. And they came in and acquired a flooring business. And the bank looked at it and said, this person has just good business experience that will help them run the business no matter what it is. It could have been a plumbing business. It could have been a restaurant possibly. It's just like, but they want to have some tie and understanding of this person knows what they're doing. They have some skills that makes them a good credit-worthy borrower for us to extend the money. Because of course, the bank wants their money back. So they want to see some expertise in the industry or some general business management or leadership skills. All right, so that's the 3 things there. Satisfying the down payment, 10% requirement, making sure you have decent enough credit and no disqualifying bankruptcies or judgments or things like that in your credit. And then the third thing, of course, is what experience or relation do you have to that business? Now, one of the ones that I've loved that I've had a couple of clients do is they sell to an employee. Banks love those ones. If there's like an existing employee in there that's like the office manager or the person that really runs that small business, they love selling to that person because they know they already know everybody, they know the business, they know the existing employees, they know the vendors, they know their relationships. It's just an easier thing for the bank to get over, thinking, can this person really run this business that they're about to buy, and we're gonna go give them money for. Now, the reason the banks love the SBA loans is because if you, the entrepreneur, borrowing money from the bank, don't pay the bank back, as long as they underwrote the loan properly, the SBA backstops them and pays the bank off. So they're incentivized to make these loans because there's little risk on them because the SBA is backing them up, but they still gotta meet these requirements, of course, is the down payment, credit worthiness, and does this person have some tie or relation to the business or some business experience. All right, now you figured out which avenue you wanna go, creative finance or SBA loan to go and acquire the small business. There's a lot of things you need to know in this process, and I've got a 50-point checklist when buying a small business to go through, but I wanna hit a couple items that are really important. The first thing is you need to decide if you're doing an asset purchase or a stock purchase. An asset purchase means you go in and you just buy the assets of the business, the name, the goodwill, the equipment, the inventory. You're not buying their company. You're not buying their LLC or corporation. You're buying all the assets of the business and you form your new company. The reason most lawyers are gonna recommend that is you don't buy the liability. The lawsuit that could be on the books, the unknown thing that pops up from a year ago that happened that went south, that's not your problem. You only bought the assets, not the liabilities. Now, the other route to go is to do what's called a stock purchase. And on bigger transactions and businesses, usually there's a stock purchase involved. And what happens in a stock purchase is you buy the actual corporation or LLC. Like you buy their company and their shares. And that company, of course, would own everything. It owns the equipment, it has the employees, it has the name and the reputation and the goodwill and all those things when you're buying a business. The downside to doing a stock purchase or buying the company is you also now have the liabilities. So if there's a lawsuit that pops up 6 months after you buy the business that happened a year before, well, guess who they're gonna sue? That same company. Now you can contractually say, hey, if I get sued for something before I bought the business, you have to come and cover that and be responsible for it. But if it was a big deal or something that was significant, they might not have the resources to cover that loss or liability. So there's a little more risk when you're buying a stock purchase. So you wanna make sure you're doing due diligence, of course, on the purchases, but you've got an asset purchase or a stock purchase. I'm gonna lean to go asset purchase for any buyer. Now, when you're going in to negotiate the price, you have to understand that every business is sold based on net income, or sometimes called EBITDA. You are buying the cash flow of the business. So you need to really understand the financials and look at the profit and loss statement to understand what's the revenue, what's the actual cash take home the buyer of the business is getting. You don't wanna be buying a business that doesn't make any money. If you buy a business that doesn't make any money, you just bought yourself a job. So you wanna buy a business that has cash flow. And that cash flow could be used, of course, to pay off the seller if you did any seller financing and creative financing. It could be used to grow the business. It's a return on your investment, just in general, that you get to take as profit. But that net income is really what you're buying in any business. And I don't care what a business this is. You're selling widgets, you're selling whatever, it doesn't matter. The whole point of any business is to have cash flow that goes to the owners of the business. So we're gonna look at the cash flow of the business. Now, generally there is a multiple applied to the cash flow or net income of the business to determine the purchase price. So for example, if a business has $100,000 in annual cash flow, it might sell at a multiple of 3 to 5. So that business might be worth $300,000 to $500,000 as a purchase price. So there's always gonna be a multiple applied. The smaller the business is, really the lower multiple. Frankly, if it was a $100,000 net income business, it's probably gonna go at a 2 to 3 multiple max. It's not gonna go at a 5. The bigger the business is, typically the higher the multiple because they're more organized businesses, less reliant on the owner. There's a lot of reasons why. But in the small business transactions, you have a lower multiple. Now, this is all negotiable. Now, there's other issues at play there. Is this a business that has a lot of inventory and equipment that I'm gonna be acquiring too? That requires a higher value too sometimes. So every business is a little different on how you're gonna value it. But the number one thing you're buying at the end of the day is the net income. That's what you're buying. You're buying the cash flow of the business. And because of that, that is what determines the purchase price. And there's gonna be a multiple applied. It varies based on size of the business, industry. There's a lot of factors that go in there. Is this a recurring revenue business where the customers pay them every year or every month? Is this a business that has a new customer every week? And so there's ongoing marketing efforts and it's a little less predictable in the future. So there's a lot of things that go into play to determine the multiple that's gonna be used to determine the purchase price. But frankly, at the end of the day, it's negotiable. Now, the next thing you need to go over is what involvement is the seller gonna have after you acquire the business? Are they gonna consult for 3 months, 6 months, a year? Are they gonna have a little ownership stake and maintain some ownership in the business with you? Sometimes that happens. But you need to determine what ownership and involvement the seller is gonna have post-closing. For the most part, the seller is gonna have a consulting agreement that says, hey, after buyer buys, I'm gonna be around for 3 to 6 months to help transition stuff, make sure you know what's what and who the employees are and the special processes we might have help you learn the business, so to speak. But after that, I'm out. Now, some businesses are being sold and the seller's gone, or there's a distressed situation and you kind of got to go figure it out, frankly. But you need to have a clear understanding of what involvement does the seller have. And a lot of businesses that are being sold, the seller already has in their mind what they want. They want to be done with it, maybe. In that case, you might just have a 3-month consulting agreement, help me transition the business, answer any questions, and then you can ride off into the sunset, seller. Some people are selling business and they're like, I'm going into retirement, but this business has been my business for 30 years. I don't want to be bored. I want to be involved. This is my baby. I've got friends and family in this business, or customers or relationships. I really want to be involved in this and helping transition this in a more formal process. And if that's the case, it might be a year or two where they're involved, or they might take a small ownership stake to retain ownership as you come over and have control and start running the business. And so those things can also be negotiated, but as a buyer, you need to understand where the seller's sitting there so you know what you're getting and where you're going to negotiate as you're coming to a final agreement, not just on the purchase price and how you're going to pay for it, but on what involvement the seller's going to have post-closing. Now, the last thing I'll say is you need to have a 100-day plan. After you acquire a business, and every good business buyer does this, whether it's a private equity group or individuals, is they have a 100-day plan. They are ready. Once the business closes, which can be a ton of work to get through that process, there's a lot of due diligence you should be doing. There's a lot of examining the books and the records and understanding the key employees. You need to be doing all that, okay? That's part of the 50-point checklist I mentioned. But when you buy the business, you need to have a 100-day plan that says, here's what we're gonna do in the first 100 days. Here's the things I gotta focus on transitioning. Here's the things I need to understand as a new owner of the business. Here's the communications that needs to go out. Here's the improvements I wanna make that's gonna grow the business to make it more valuable from the day I bought it. And that 100-day plan then, of course, needs to be executed on. So make sure you have an actual business plan and understanding what you wanna do when you get into the business. Now be flexible about that too, because there's a lot of stuff you don't freaking know until you own the business. Be willing to change that and update it. But realize running and owning a business is work. It takes your time and effort. And if you're trying to maximize the value, don't think you can just buy a business and go sit back in the chair and just go bark orders and tell people what to do. You're gonna need to get involved. That's where you're gonna really drive value and grow your investment, which is now your future ownership of the business, that hopefully you can come back and sell later for a profit. Now, I hope these tips help to understand how to buy businesses. This is one of the best ways to accelerate and grow your wealth, is owning a small business. I've got a lot more tips on this on my channel. Please make sure you're subscribed. I go live weekly. I'd love to see you back here next time.